Might not be the thrilling ride of a roller coaster, but I think in retirement, most of us like to know that defined outcome, as we go through our retirement and to de-risk your lifestyle and, try to, bring that stress level down even, Peter.
Well, we have certainly seen some market volatility over the last couple months. How much does that affect our state of mind and our planning, our long-term outlook for the financial future? We'll talk about that today with Chris McIntire, president and founder of McIntire Retirement Services, as well as how much we can plan for our financial future and how much we just rely on the direction of the market and maybe some timing and luck. We want to get your insights, Chris. We always appreciate the time here on the program. Chris McIntire, of course, ladies and gentlemen, Northwestern Ohio's resource for a common sense approach to investing, to money, to finance, to planning for retirement. President and founder of McIntire Retirement Services. Chris, I'm certain you've got your fingers on the pulse and you're probably hearing a lot about the recent market volatility.
Yeah, I think I need to take the pulse of several clients out there that get a little bit nervous here when things get volatile and look, you and I know that on average the S&P 500 corrects 15% in any given year at some point. So, I don't think we're out of whack here and expecting some volatility given talks of tariffs and whatnot. But, hey, if you're still working, putting money in, these little dips are great buying opportunities for you if you're reinvesting your dividends, things like that. And, if you're invested in a risk appropriate portfolio for your overall risk tolerance, then, maybe just turn the news off and, watch the spaceships land in the water and watch them, what this country can actually do when it gets behind itself.
Yeah. And I think that's critical. We stress and emphasize often on the program, Chris, having a plan is going to lead to more sanity, stability, peace of mind, regardless of the direction of the market, but also allow you to identify when opportunities are present and see things. When other people are panicking, when the market is down, there may be opportunities within that chaos, and the direction of your money often matters as much, if not more, than the direction of the market. You mentioned if you're still contributing, this is a pretty fantastic opportunity. You're buying cheaper than you were 2 months ago and really for the last 6 months.
Yes, and we don't want to discount the emotion that comes into play for, those recent retirees, especially, who are now depending upon the portfolio to pull money out of, and all of a sudden, you start getting some pretty sizable moves in the market, and 2% in a day is a pretty big swing there.
Sure.
But we run across a number of clients in these conditions right now, and we use strategies that provide buffers, strategies that, offer some downside protection like our structured notes. And, you get to looking at a portfolio after you get an email. It's like, you're down 1.5% here. I mean, you're not like you're invested in Nvidia that falls, that's been one of the more volatile stocks as an example. And, still a very sought after company here. So, we're not, facing crises and whatnot, but somebody hears the word recession and tariffs and trade wars, obviously those things are, can make you nervous, but also, the news knows those are hot button words to use to keep you tuned in.
How much of the emotion, Chris, is driven because people are paying more attention to the news rather than really having a firm grasp on what they have in their portfolio or where their dollars are or what they're doing? I mean, I know
Yeah.
that the market has had volatility. And when the news continues to report that, especially hounding on the downside of volatility, that is going to lead to emotion. But like you mentioned, like a lot of people, especially for those who had a plan that you have put together that game plan for retirement, expecting that there's going to be both good times and bad that come along, what is being talked about on the news might not be reflected in their portfolios, as you indicated.
Yeah, you're exactly right. So, for example, the market gets volatile. People flock to 10-year government bonds, for example. Okay. Well, that pushes the interest rates down, but yet you don't hear a word about mortgage prices falling significantly. You got to read in page 18, depending or whatever news channel you watch, that egg prices have fallen substantially, that oil prices have fallen substantially. I mean, those are the equivalents of tax cuts for crying out loud, and
Hmm.
we don't want to overshoot this or but my goodness, we get, somebody says, "Wow, the market fell 2% today. Should we go in cash?" I'm like, "Yeah, but you're 20% in stocks, 80% in bonds, and bonds went up today. So, like Peter was how he framed his question there was, do people really know what they're invested in, before they send that email?
Yeah.
Typically, no.
Yeah.
They're just, they're watching the headlines and look, I'm nervous. Is the market going to free fall? Because if you think about it, let's go back to, frame this in 2020. The S&P 500 fell 30% in the month of March. Man, that's an emotional gut check for sure. Um, Go back to the 2008 financial crisis. In today's retirees, that was a buying opportunity, but they remember just how bad that was. And that was a crisis. COVID was a crisis. Okay. And then government overspending by both parties, to be politically neutral here on today's show, led to inflation, where in 2022 they raised interest rates 11 times in a row, sometimes 0.75% a month. That was supposed to throw us in a severe recession because they raise interest rates to do economic damage. And look what happened in 2023, 2024. We still haven't gone into a recession. So, I mean, if you think about it and you start putting it into perspective of what people's frame of reference is, it's not an economic slowdown. It's been crises. So, our world is as much psychology as it is money sometimes.
Well, it is always a good time to plan, but still an especially good time to put that game plan for retirement together. Those personalized plans that Chris McIntire helps to craft, create, implement, and execute, and then continue to monitor on behalf of his clients there at McIntire Retirement Services. And if you would like to get your personalized game plan for retirement, pick up the phone and give a call, 419-332-0532. That's 419-332-0532, 419-332-0532. And markets are still high, right? We've seen a little pullback, but we're about where we were 5 or 6 months ago. And 5 or 6 months ago, we were not all panicking. The market's at the same point that it was at that time. Taxes are still historically low, right? There are opportunities, Chris, and I know that for those people who you've had the plans put together for previously, they've got a little bit more confidence that their plan is going to continue to work regardless of the direction of the market, because that's what the plan is for. It planned for ups, downs, sideways in the market, rather than simply relying on the luck of timing retirement at the right time. And you've talked about sequence risk. Sequence risk specifically is something that illustrates this luck of timing and how we want to sort of remove that from the equation and take it off the table. Can you explain sequence risk for us?
Yeah, sequence risk is deals with the sequence of the returns of the stock market while you're putting money out, pulling money out for, our discussion here today. And, if the if you've just retired, for example, and you got, we'll just easy number, $1 million in your IRA account, and you want to pull 4% of that out, because we've all heard of the 4% rule. So you're going to pull $40,000 at some point throughout the year out, monthly, annually, quarterly, whatever it is. Okay. Well, if the market falls by, or your portfolio, let's say that falls by, 15%, all right, well, now you got 850,000. Okay. All right. And you need to pull out 40,000 out of that. Okay. Well, now your withdrawal rate needs to go up, call it, 4.5%, 5% basically, to make to manage that rate of return, or that to keep up with that withdrawal rate that you have. And, and then if the next year it falls by another 10%, that's sequence risk. Okay. Especially early on in retirement. And that's why we always talk about, look, we need to have an alternative strategy over here. If we're going to live off of investments primarily, sometimes they're not going to deliver and do what we need them to do. Okay. 2023, 2024, everything did just fine. Heck, you could have bought a new vehicle, probably at the end of the year because you had some decent returns. Okay. But a 2022, if you would have retired, stocks lost, bonds lost. Okay. And, that would make that, bonds fell 15, 20%, stocks 15 to 30%, depending on what index you want to use as a frame of reference here. Man, that's a gut check to have people say, well, boy, I still got to pull, $5,000 a month out of my portfolio. I need 6%. I just couldn't handle working previously. So, working through those sequence of returns where, if you'd have had some money in a money market account or an alternative strategy, a CD, a safe annuity of some sort, maybe you went over there and pulled that income out and didn't pull out of your portfolio. That's what we mean by a plan B. Have enough on a side cushion to get you through a couple of storms here, if you will.
Yeah. And you mentioned that sequence of returns explicitly, specifically happens as you are pulling money out. And I had mentioned earlier that the direction of your money matters almost as much as the direction of the market. You've got a couple different reports and examples of sequence of returns risk. And I'm a math nerd. I love them. I dug into them. I found it super interesting that if you're not adding money, nor taking money out, no contributions, no withdrawals. If you just have a balance over a period of years, whatever the returns are over those period of years, you can take them, you can shuffle them, you can put those years and those returns in any order. And if you keep the same returns, no matter what order they happen in, you get the same result at the end. The same amount of money turns into the same amount of money, regardless of the order of the returns. That was actually pretty interesting to me. But then, Chris, when you add making contributions, or especially as we're talking about here for retirees, sequence of returns risk, you start making withdrawals, the order of those returns can absolutely determine the entire trajectory and the outcome of what you have at the end. And you had a interesting example with siblings. Bill and Jill, they retired in different years, but with the exact same amount of money. They took the exact same approach with how they invested, and the 4% rule, they followed that. The exact same amount of income, but they had very different results because of the early returns in their experience. They were a couple years apart in age. Can you talk about Bill and Jill?
Yeah, so Bill and Jill, good example, and we do this in our retirement classes, and we have a couple of those coming up here in the middle part of April at the Terra Community College, and we give some specific examples where you get a big visual here, and you can call Heidi at our office to get those exact dates. I didn't write them down here for the show, but here in the middle part of April, we got a 2-day retirement class we do at Terra Community College in Fremont, 6 o'clock, 9 o'clock at night, to throw a commercial in the middle of this. And in the example we use in the college class is like, Bill retires in 1990, Jill retires in the year 2000, for example. Well, Bill caught the tech bubble as he was retiring, okay? And Jill, she caught the tech crash as she was retiring. So she starts out retirement with 3 significant years of decline in the market, where Bill had 3 significant years of upside in the market. And just the numbers just blow your mind away. You're like, look, they took the same money out, and like Peter says, we can reverse those numbers, and it's amazing the difference. So, it's the same set of returns. We talk about Monte Carlo simulations and all of that. Well, and again, that's why you want to manage your risk. And one of those risks is sequence risk, the withdrawal rate risk, market risk, but even inflation risk, interest rate risk. There are a number of different items that come up as we go through retirement that we never thought about while we were working as much, and I'll give you an example, right? We talk about sequence risk as money coming while money's coming out. Okay. We have this little dip, and I guarantee you, Peter and I both put money in during this little dip. And I had previously bought an exchange traded fund related to nuclear power, right? Powering all this AI and small modular reactors. And I got enough clients that work at Davis-Besse Nuclear Power Station or retired. I probably have about half a degree in nuclear energy here. But that one ETF, when I bought it, as they were trying to ramp things up, well, it fell 27%. So I don't have a lot in there in my portfolio. So what did I do? I bought more. If it fell 20, that's when I want to buy. I don't want to sell down there. And but just an example, I took advantage of the sequence of returns risks to put money in. And again, for most of our clients, we're managing sequence of returns risk with money coming out.
And Chris, that's not timing the market. That's taking advantage of where the market is, right? It was a good time to invest, and it happened to be that the market is at a discount. And we've got to look at those things, right? But relying on luck, I think that's what gets in the way of a good plan and lasting financial confidence. And that's why Chris McIntire, ladies and gentlemen, puts on those retirement classes. Find out when those are coming up in April at Terra State. Give the office a call. Get your personalized game plan for retirement, the written plan put together. Give McIntire Retirement Services a call, 419-332-0532, 419-332-0532, 419-332-0532. A lot of people's plans, Chris, I think are based on some assumptions, like the market is always going to go up. And then when it doesn't happen, they get surprised or scared that taxes are going to remain low forever, right? That's an assumption that we sort of base our planning and our financial future on. I think we've talked about far too many plans, and you just mentioned it, don't really include inflation. They assume that costs and prices and expenses are going to stay the same into the future and that we're always going to remain healthy. Like, in your planning process, as you're helping people design their personalized game plan for retirement, I think that's what leads to enduring financial confidence, is the fact that you really question those assumptions and say, well, what happens when things go wrong during the planning process so that people are prepared if they happen in real life.
Yeah, without a doubt, Peter. And good point. I like the way you framed this is, and you can tell by some of the gray hairs on my heads here, and some of that's coming from my Red Wings that can't win a game. And I've got to say that Peter and I are hockey fans here while I wear an Ohio State shirt. And uh, but we've been in this so long now that, some of our clients that were 70 years old are 95 and have passed away. And we moved our office from downtown Fremont or from a second floor to a first floor in downtown Fremont. And, we went through a lot of files and whatnot. And, man, as I'm looking through there, I'm like, oh my goodness, how many of them, some serious health issues who had passed away. And, you talk about planning and, look, plans and things change, life changes, we live in Ohio. We have 4 seasons. There's, sometimes we take the screens out, sometimes we put them back in for seasons. We winterize the house for winter. We check the air conditioning and whatnot for summer operations. We plan for these things to happen, and when things do change. And one of the big things that we try to get across to our clients is, look, this long-term care thing is real, and it can be incredibly expensive. As we've transitioned my father-in-law from home care, where we had people taking care of him. He had to go into some rehab, and now might be looking at a longer stay in a nursing home. And may not come back out of that. And do you how do you pay for that? It can be incredibly expensive. Do you have veterans benefits? And that's one element. you know, and then, you back that up to like Peter says, and the whole tax side of things here, how do you legally keep what you can? What are the planning steps? You put all this money into a 401k, and now you've got to take some of that money out to live on. When you pass away, your kids now have to take that. And one of the changes they made was under the Secure Act was, all right, instead of a non-spouse beneficiary like kids, grandkids, brothers, sisters being able to inherit an IRA and take it out over the rest of their lives, they have to empty it within 10 years now. And IRA accounts haven't gotten smaller, they've gotten bigger because you've been allowed to put more and more dollars into there. So, that tax piece changes throughout retirement as well. It's just a couple of examples there.
Again, if you would like your personalized plan, examining those assumptions, the variables that your plan is, and your financial future, your lasting financial confidence are based on, you need to examine those things very carefully, ladies and gentlemen, especially if you've got emotion or concern or worry about seeing this recent bout of market volatility that we are moving through now. If you've got that concern, pick up the phone and find out if your plan accurately reflects your position, where you're at today, your timeline, where you want to be in the future, your goals, your objectives, and helps you accomplish and achieve those goals that are important to you. Chris McIntire can help personalize and customize a written plan for your financial future, can help run an analysis on the current accounts and the investments, let you have an inside look, make sure you understand what you own and what your money, what each and every dollar is doing for you. The plan is your game plan for retirement. He'll put that together, helping you review and evaluate income, investments, taxes, healthcare, legacy, many, many more things, how to optimize Social Security. Medicare comes in, how to be efficient with the income that you are creating, all of that part of the process. And you can give a call and you can take advantage at no cost, no obligation for putting that plan together. 419 332 0532. 419 332 0532, the number to call. Chris, for those who are worried about seeing this recent market volatility, you do have strategies that help to minimize that volatility or the impact of down times in the market.
Yeah, we work with our investment advisory team over at Brookstone Capital Management that, they provide us with instruments like a structured note that essentially protects you from any loss until the S&P 500, the NASDAQ, Russell 2000, something along those lines, falls by 30%. And some of those notes are, pretty high paying. It could be, high single digits to low double digits. And I mean like 10, 11% for a 1 year note. And you can't lose anything unless the market falls by 30%, in that 1 year time frame. We have buffered strategies where, you can buffer the first 15% of the downside of the S&P 500 over, what we call an outcome period, but also deliver some upside potential, and those are just, the investment side of things. We also use, fixed annuities, fixed index annuities, CDs, money market accounts on the safe side. And, we try to match this up with liquidity needs, with the overall risk tolerance, but, to try to deliver, a decent rate of return for a client in retirement so that, that they can keep pace with inflation, have some withdrawal, ability to withdraw, some of their earnings and, leave the principal intact, many different scenarios. And, look, it's not a perfect world, so there are no perfect investments. That's why you need to diversify your portfolio. Like right now, stocks are coming down, but bonds are providing that cushion like they, normally do. Thankfully, they're not raising interest rates 11 times in a row where bonds weren't providing that protection back in 2022, as an example.
You mentioned the define outcome investment options and those things that give you that downside protection while still sounding like a pretty attractive upside potential or interest rate, and bonds being the cushion. Like, there are alternatives here. And Chris, we're talking on the program today. The theme was luck versus planning, and making sure that we are planning on confidence, not just lucking into it. When you, I'm not going to say one is better or anything is better than the other. But in our conversation of luck versus planning, having a defined outcome in your plan versus simply having a projection, I feel like one of them would lead to more confidence for me personally.
Yes, absolutely. And, it might not be the thrilling ride of a roller coaster, but I think in retirement, most of us like to know that defined outcome, as we go through our retirement and to de-risk your lifestyle and, try to, bring that stress level down even, Peter. I mean, think about this. I remember my dad going through this, coming up on 92. He really got hurt in 2001, 2002, way back in the day because he was just getting ready to retire. So, a lot of these things that we talk to our clients about, look, we're dealing with family members in the present, or we've dealt with those things in the past. And, and as we've been in business for many years, our book of assets that we manage is substantially larger. And, I'll be honest, in this market upheaval, it's been relatively quiet. Three, maybe four emails in all of this
Yeah.
and some people are just, hey, what's your thoughts on this?
Well,
And
I
that's a
mean,
normal email there.
yeah,
Yes.
but you put those plans together for your clients. They've got the game plan for retirement prior to market downturn, right? And if somebody is excessively worried or nervous right now, maybe they are overexposed to risk or underprepared for it or don't have that plan in place. And I find it striking, Chris. You're talking about previous generations and your dad and a generation before that, like they had pensions, they had that defined outcome. That was the plan for them. Today we have more personal wealth, but it's all investment, and we've got more uncertainty, more worry about running out of money. I think more nerves when the market is volatile. So has that transition to having this much larger pot of personal investments versus the defined outcome really equated to quality of life in retirement for us?
Absolutely, Peter. And you remember, and our good friend Dave Gaylor, said, peace of mind is your quality of life, and God bless him and may he rest in peace. But one of his analogies there, and I remember, Dave saying he recruited many advisors to kind of mentor them with our dear friends at the previous three mentors was, look, if you follow our plan, I guarantee you won't fail. And that's what we like to, help our clients is, we got to be careful using the word guarantee, obviously. But that's why we invest in review and whatnot and try to keep them informed and, try to stay neutral on the emotions, and again, in our political climate we live in today, I mean, emotions are on edge, obviously. And, I hopefully that, we all watch that spaceship come down here that a company called SpaceX, obviously Elon Musk, but when they interviewed Elon afterwards, he wasn't talking about Republicans or Democrats. I mean, they went up and got two Americans. Nobody checked their color, their creed. They were Americans that needed to come down. And believe it or not, there was a Russian cosmonaut in there. So, man, it was nice to watch something like that where humanity came together and wasn't worried about identity politics.
Well, we always appreciate the time here on the program, Chris. And ladies and gentlemen, we have been dealing with some market volatility. That does have a lot of people reasonably worried about the financial future. But if you've got a plan in place, you can see your way through it and keep that long-term vision, which is the formula. It is the secret for financial success, is keeping your eyes on the goal, way on down the road, not what's happened the last 2 months. So if you would like to get your personalized written plan for retirement, your game plan for retirement, or if you'd like to learn more and attend a couple of those upcoming classes at Terra State, pick up the phone, give a call McIntire Retirement Services at 419-332-0532, 419-332-0532, 419-332-0532. Chris, we always appreciate your time here on the program. Thank you for being here today. Always a pleasure.
Yeah, my pleasure, everybody. Be safe out there and may God bless America.
Tune into Chris McIntire's full radio program and visit McIntireRetirementServices.com for many additional valuable resources, including other great episodes of Game Plan for Retirement with Chris McIntire. Be sure to subscribe.
The content of this radio show is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. You are encouraged to seek investment, tax, or legal advice from an independent professional advisor. Any investments and/or investment strategies mentioned involve risk, including the possible loss of principal. Advisory services offered through Brookstone Capital Management, a registered investment advisor.
Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.